Warsh just declared. Here's exactly what he said and what it means for silver. A man who once crashed an entire market just by being nominated stood behind a podium today and said almost nothing. But what he didn't say is now the most dangerous part of this story. Somewhere in a sentence he refused to finish is a decision that will move billions of dollars before the weekend even begins. 3 numbers changed today, numbers most people will never see, buried inside a report nobody reads in full. And one of those numbers is sitting less than 1% away from a threshold that, historically, has only been crossed 3 times in the last decade. Each time, it ended badly for someone holding the wrong position. Right now, in vaults most investors have never heard of, something is quietly running out. Not loudly, not on the news, just running out. This isn't a story about silver going up or down. This is a story about what happens in the 72 hours after a man chooses his words, more carefully than anyone in that room realized. Stay until the end, because the most important number in this entire briefing is the last one revealed. Welcome to Currency Insight. Now, before we go any further, I want to ask you something. Not because I have to, but because over the years I have learned that the people who follow this channel closely, the ones who never miss a briefing, they are the ones who are prepared when the rest of the market is caught off guard. So let me ask you plainly, the way one would ask a trusted friend, someone who has lived through enough market cycles to know the value of being early rather than late. If this channel has helped you see what others overlooked, if even once something explained here saved you from a costly mistake, will you do us the kindness of subscribing? It costs you nothing, but it means the next time something like this unfolds, you will hear it from us first, not from the headlines 3 days late. And I am curious, where in the world are you watching this from today? Drop your city, your country down in the comments below. We have viewers from every continent tuning into these briefings, and I would genuinely like to know who is sitting on the other side of this screen tonight. Now, let us begin. He walked to the podium at exactly 2 o'clock, and for the first few seconds, he said nothing at all. Reporters in the room would later describe that pause as unusual. Not dramatic, not theatrical, just unusual. Because every Federal Reserve chair before him had used that silence to build anticipation, to let the cameras catch the moment, to let the room feel the weight of what was coming. Kevin Warsh used it differently. He used it the way a man uses silence when he has nothing he wants to add to what is already written down. This detail matters more than most viewers will realize. To understand why, one has to go back further than today's meeting. One has to understand who Kevin Warsh actually is, and why his presence behind that podium represents something the financial world has not seen in over a decade. For 20 years, Warsh built a reputation as one of the loudest critics of the very institution he now leads. He did not criticize the Federal Reserve's goals, he criticized its method. Specifically, he criticized something called forward guidance, the practice of telling markets, in advance, what the Fed intends to do next. Previous chairs believed this practice created stability. Warsh believed the opposite. He argued, repeatedly and publicly, that forward guidance created false confidence, that it encouraged investors to take risks they would not otherwise take because they believed they knew what was coming. And when conditions changed unexpectedly, as they always eventually do, the market was left exposed, having built its entire strategy on a promise that could not be kept. This is not a small disagreement between economists. This is a fundamental difference in how a central bank chooses to communicate with the entire financial system, and it explains exactly why Warsh's Senate confirmation became the most contested in modern Federal Reserve history. He was not confirmed because everyone agreed with him. He was confirmed because enough people believed the old method had failed and that something needed to change. So when he stood at that podium today and chose his words with visible restraint, he was not improvising. He was not being cautious because he lacked confidence. He was doing exactly what he told the Senate he would do. He was refusing to hand the market a map. This single fact changes how every word from today must be read. Most analysts watching the press conference were trained to listen the way they listened to his predecessor. They were waiting for the phrase that would move markets, the sentence that would confirm a timeline, the hint that would tell them what happens next. They did not get it, and many of them are going to walk away tonight believing that nothing important happened. That belief will be a mistake, because the absence of guidance is not the same as the absence of information. When a man who has spent 20 years arguing against forward guidance refuses to give forward guidance, that refusal is the message. It tells every serious investor that the rules of the last decade no longer apply. It tells them that the Federal Reserve is no longer going to hold their hand through uncertainty. It tells them that markets which have grown comfortable being told what to expect must now learn to function without that comfort. For silver holders specifically, and for commodities more broadly, this shift carries enormous weight. Precious metals markets have spent years pricing in expectations based on Fed communication. Investors have learned to react to specific words, specific phrases, specific signals. Today, those signals did not arrive in the way they were trained to expect. And a market trained on signals that suddenly stops receiving them does not become calm. It becomes uncertain. And uncertainty, in a market already stretched between physical scarcity and paper speculation, is rarely a quiet force. What happened today was not a routine press conference. It was the first real demonstration of a philosophy that has been theoretical until now. Warsh did not perform the role of Fed chair the way the public expected him to. He performed it the way he always said he would, deliberately, carefully, and without the safety net that markets have relied on for over a decade. The room did not fully understand what it had just witnessed. Most coverage tonight will focus on the rate decision itself, the part that was never actually in question. Very few will focus on the deeper signal Warsh delivered simply by refusing to speak the language everyone expected him to use. But somewhere, in trading desks and boardrooms preparing for tomorrow morning, a smaller group of people already understands exactly what just changed. And they are not waiting for the headlines to catch up. While reporters focused on the podium, a smaller group of people had already moved their attention to a different page entirely. A page most viewers at home would never think to look at. A page filled with nothing but small dots scattered across a grid, each one representing where a single Federal Reserve official believes interest rates should sit in the years ahead. This page is called the dot plot. And today, it told a story far more revealing than anything spoken aloud at the podium. To understand what changed, one must first understand what existed before. Back in March, the last time this same chart was published, the median official on the committee expected exactly one rate cut before the end of the year. Just one. It was not a bold prediction. It was a quiet acknowledgement that some easing, some relief, was still considered likely. For months, that single projected cut had served as a kind of anchor. Precious metals markets, including silver, had partly built their pricing around the assumption that this one cut was still coming. Today, that cut disappeared. The median projection for the rest of the year shifted to show interest rates holding steady, with no reduction at all between now and December. And the committee's outlook for the following year drifted higher as well, suggesting the path toward lower rates has been pushed further into the future than anyone expected just 3 months ago. But the disappearance of one rate cut was not the most striking detail buried inside that page. The more unusual development involved a different kind of dot entirely. Before today's meeting, several analysts had quietly flagged a possibility that seemed almost unthinkable a year earlier, that a handful of voting members might pencil in an actual rate increase for this year. Not a pause, not a hold, an increase. That possibility became reality. Multiple members marked their projections higher, signaling that if the committee's next move comes at all, it may move upward rather than downward. For a market that had spent years assuming rates only moved in one direction eventually, this shift represented something close to a reversal in psychology. Yet here is where the story becomes more complicated than the chart suggests, and where most casual observers are likely to misread the entire situation. Those hawkish projections were not written today. They were submitted earlier in the week, before a separate and rapidly developing situation had fully settled into the global economy. A major geopolitical resolution involving oil supply routes had only begun affecting energy prices in the days leading up to the meeting. The full impact of that shift had not yet worked its way into the data committee members were using when they made their projections. In simple terms, the dots reflect a world still operating under higher oil prices, a world that, by the time the next projections are published, may no longer exist. If energy costs continue falling as expected, the inflationary pressure that helped justify today's more aggressive projections will soften considerably. The foundation underneath these hawkish dots is, in a very real sense, already eroding before it has even been fully absorbed by the market. This timing detail rarely makes it into mainstream coverage, yet it may be the single most important fact for understanding what happens next. A hawkish signal built on outdated assumptions does not carry the same weight as a hawkish signal built on a stable, unchanging reality. Investors who treat today's dot plot as a fixed forecast, rather than a snapshot of a moment that is already changing, risk making decisions based on information that is quietly becoming obsolete. There was one more detail buried inside the dot plot discussion, mentioned briefly, almost in passing, yet carrying weight far beyond its brief mention. Officials indicated that the Federal Reserve's broader balance sheet policy would be reviewed in the coming months, with language suggesting that the process of reducing that balance sheet could continue or even intensify. This process quietly removes money from the financial system over time. Unlike a rate hike, it rarely makes headlines, but its effect on assets like silver can be just as significant, tightening financial conditions without a single increase to the benchmark rate. Taken together, the dot plot revealed a committee positioning itself for a tougher stance, built on data that may not survive the next 90 days. For those willing to read past the surface numbers, the real signal was not where rates are heading. It was how fragile the reasoning behind that direction has already become. Away from the podium, away from the dot plot, away from anything spoken in front of cameras, a different story had been quietly unfolding for months inside a much less visible part of the financial system. It involved no press conference, no prepared remarks, no committee vote. It involved warehouses, ledgers, and a number that had been edging closer to a threshold few outside specialized trading desks ever monitor. This story concerns silver itself, not as a price on a screen, but as a physical metal sitting in storage, waiting to be claimed. To understand the situation, one must separate two very different categories of silver that exist within the exchange system. The first is called registered silver. This is metal that has been physically committed, fully documented, and made legally available for delivery to anyone holding a contract that demands it. As of this week, that registered category held just over 86 million troy ounces. The second category is something else entirely. It is paper, specifically futures contracts, financial agreements that allow a holder to demand physical silver at a future date. On the contract expiring next month alone, more than 228 million ounces worth of these paper claims existed. In other words, for every single ounce of real, deliverable silver sitting in those vaults, there were more than 6 ounces of paper promises pointing toward it. This relationship between paper claims and physical metal is measured by something analysts call a coverage ratio, essentially a percentage representing how much of the outstanding paper could actually be satisfied with metal available today. That number currently sits at roughly 15.5%. Historically, when this ratio drops near 15%, it has marked a recognized stress zone, a point where the system's ability to meet demand becomes genuinely uncertain. Today's reading sits only a fraction above that line. This is not a theoretical concern, it is measurable, and the trend leading into this moment has been building for years, not weeks. Total physical deliveries through the exchange rose sharply year over year, more than doubling between recent years. And in just the first 5 months of this year alone, the amount of silver physically delivered out of the system reached a figure equal to roughly 1/5 of the entire world's annual mine production. Production that, by most industry estimates, takes mining companies an entire year to extract from the ground. There is a further detail that rarely receives attention, yet deserves serious consideration. Within the broader pool of silver sitting in storage, a significant portion belongs not to active traders, but to a major exchange-traded fund that holds physical metal on behalf of investors. Once that portion is set aside, the silver that remains truly free, neither locked into delivery commitments nor held by that fund, becomes considerably smaller than the headline numbers suggest. Now consider how today's monetary decision connects to this physical situation. When markets fear an aggressive shift from the Federal Reserve, speculative holders of silver contracts often choose to exit their positions early, closing them out before facing the possibility of being forced into physical delivery. That fear had been quietly encouraging some of this early exit behavior over recent weeks. But today's meeting did not deliver the kind of sharp, unmistakable signal that would have pushed large numbers of remaining holders to abandon their positions. This means a meaningful portion of those outstanding contracts representing real claims on real metal, may now remain open heading into the most important delivery window of the season. Each one represents a decision still to be made by someone holding a piece of paper that says they are owed silver that may or may not still be sitting, unclaimed, inside a vault. The monetary story occupies headlines. The physical story occupies vaults. And while one moves in hours, shaped by words chosen at a podium, the other moves in ounces, shaped by decisions made quietly, away from cameras, by people who have no interest in waiting for the market to notice what they already know. Everything that has happened so far, the careful silence at the podium, the quiet shift in the dot plot, the tightening pressure inside the vaults, now converges on a single stretch of time. 10 days. 10 days in which several separate developments, each one significant on its own, are scheduled to collide. The first of these arrives almost immediately. A formal international agreement, one that has already begun reshaping global energy markets, is set to be signed within days at a diplomatic gathering in Switzerland. This is not a rumor circulating among traders. It is a confirmed event, with officials from multiple governments having already validated the date and the terms. Once signed, the agreement removes a layer of uncertainty that had been keeping oil markets cautious. Routes that had been disrupted reopen. Energy prices, already falling in anticipation, become locked into a new and lower trajectory. This detail matters far beyond the energy sector itself. The reasoning behind today's more cautious Federal Reserve projections rested heavily on inflation concerns tied to higher oil prices. Once those oil prices are no longer elevated, once the agreement becomes permanent rather than anticipated, the foundation supporting today's hawkish positioning weakens considerably. Every week that follows with lower energy costs makes the case for aggressive policy harder to defend. The second major development arrives almost immediately afterward. The exchange enters what is known as First Notice Day, the point at which holders of expiring silver contracts must decide whether to close their positions or stand prepared to receive physical metal. This is the moment the vault situation described earlier stops being a quiet background concern and becomes an active, immediate test. Every ounce of registered silver, every outstanding paper claim, every percentage point of that delivery coverage ratio becomes relevant in real time. Three specific indicators deserve close attention throughout this window. The first is a short-term government bond yield, which tends to reflect almost immediately how markets are interpreting the Federal Reserve's likely next move. A rise above a certain threshold would suggest markets are pricing in a more aggressive stance. A level below it would suggest the opposite. The second is the closing price of crude oil on the day the international agreement is formally signed. A price that falls meaningfully below recent levels would confirm that the inflationary argument behind today's projections is losing relevance in real time. The third, and arguably the most important, is the daily registered inventory figure inside the exchange's silver vaults. This number, watched closely by a relatively small group of specialists, will reveal whether physical metal continues flowing into the system or whether it begins draining at a faster pace as delivery demands intensify. None of these three indicators exist in isolation. They are connected, each one influencing how the others are likely to behave. A weaker oil price reduces inflation pressure. Reduced inflation pressure changes how markets interpret bond yields. And changing market psychology directly affects how many contract holders choose to stand for delivery rather than exit early, which in turn determines how quickly that vault inventory shifts. For now, all three indicators sit in a state of uneasy balance, none confirming disaster, none guaranteeing stability. What happens over these 10 days will determine, with far more clarity than any single press conference could provide, whether today's quiet, careful silence at the podium was simply caution, or the calm before something considerably larger begins to move.